Hello, and welcome to the Freight Flow Advisor Brief. Today, I want to talk about Dollar General because if a tornado can take out a 1,000,000 square foot distribution facility and still somehow end up improving your supply chain, you must be doing something right. So before you ask, yes, I'm talking about that Dollar Tree, that local neighborhood dollar store. But behind the scenes, what you don't see is that it's quietly becoming one of the most disciplined freight buyers in North America. Not only do they have a new Arizona distribution center, the Oklahoma hub getting rebuilt, and 75% of their freight volume is locked into multi-year contracts. Beyond all that, they have a phenomenal tech stack that actually shows up in the P&L. So listen, if you own trucks, buy freight trade, or maybe you underwrite your own network, this story is worth listening to. So let's rewind the clock a little bit and get into the Dollar Tree story. In 2024, an EF4 tornado destroyed Dollar Tree's distribution center in Marietta, Oklahoma. And that facility anchored much of Dollar Tree's network. Now, if you fast forward to 2026, they've just opened a 1,000,000 square foot distribution center in Litchfield Park, Arizona. That's right outside of Phoenix, with outbound shipments starting as soon as June and coverage for roughly 700 stores across Arizona, Colorado, Nevada, and Utah. They're constructing another distribution center in Marietta, Oklahoma, that's slated for an open in spring of 2027. That's also going to support 700 stores. And maybe the most important number in this whole episode, Dollar Tree now has about 75% of its inbound and outbound freight locked into multi-year contracts, with spot market exposure only at about 25%. Now listen, that's a statement about how they intend to buy capacity going forward. So we talked about the tornado in April 2024, but we didn't talk about how bad it was. It nearly wiped the Oklahoma distribution center off the map. And that fundamentally reshaped Dollar Tree's capacity, distribution capacity, line haul, and skyrocketed transportation costs overnight. Dollar Tree's own commentary was blunt. Losing that facility added miles. It strained freight networks and pushed up costs. If you're a retailer that has thin margins, this is your prototypical nightmare scenario. But it's important to note that this is not Dollar Tree's first freight crisis. In 2021, when ocean and truckload markets blew up, Dollar Tree told investors elevated transportation costs would drag down full-year earnings by $1.50 to $1.60 per share, on top of approximately $185 million in freight spend. And that was against their original forecast. That's the kind of hit that gets you downgraded, and it puts a spotlight on your supply chain. So by the time the tornado hit in 2024, Dollar Tree had already seen what uncontrolled freight volatility does to earnings. What we're watching now is the second generation response: more capacity in better places and more predictable freight costs. The Litchfield Park Distribution Center isn't just a replacement box. It's a 1.25 million square foot facility in a growth region serving hundreds of stores in the Southwest. So not only did Dollar Tree learn from experience, they doubled down on their network, understanding that diversifying their supply chain makes them a stronger organization. So let's talk about that 75% freight contract, because I feel like that's a really important part of this story. At Dollar Tree's Investor Day, Chief Supply Chain Officer Roxanne Wang laid it out. Roughly 3/4 of Dollar Tree's freight, inbound and outbound, is now multi-year contracts, and another big chunk is in one-year contracts. The residual sliver sits in the spot market. So depending on your viewpoint, that is either a brilliant hedge against the next capacity crunch or a potential risk if you believe we're locking in at the top of the rate cycle. Here's where the opinion comes in. From Dollar Tree's perspective, this is absolutely rational. They have already lived through the freight chaos plus fixed low price problem, because in 2021, they couldn't just pass everything through to the consumer because half the banner was literally branded around a single point price. When your core product promise is, quote, everything's around $1, there is a hard ceiling on how much you can push freight cost downstream. So they did the opposite. They pulled volatility out of the system. Multi-year contracts give them predictable landed costs, more credible margin guidance to Wall Street, and more importantly, a tighter partnership model with core carriers instead of endless RFP roulette. For carriers who made the cut, this is gold. Multi-year volume on lanes tied to a major retailer's distribution center in both Arizona and Oklahoma is the definition of anchor freight. It justifies fleet investment. It supports driver recruiting, and it smooths your own exposure to the spot market. For everyone else, like brokers, small carriers, and folks who live off that volatility, this is the writing on the wall. The big, sophisticated shippers are using contracts and analytics to vacuum up the best capacity on multi-year terms. The leftover volatility will be thinner, sharper, and harder to trade. And there's a bigger signal here. If you don't know the true cost to serve by lane, by season, by contract structure, you're negotiating blind against shippers like this. So as always, we're taking a quick break to talk about Freight FA. Because if you're listening to this and wondering, how do I actually get to the Dollar Tree level with my own freight costs? That's exactly why we built Freight FA. And more specifically, our flagship tool, Freight GPT. You see, Freight GPT is an AI-powered freight analyst that lets you do in minutes what used to take a team and a week of spreadsheets. You can drop in your lanes, think Phoenix to Denver, LA to Chicago, Chicago to Atlanta, and you can get AI generated cost estimates based on current market conditions and historical patterns. You can test scenarios the same way Dollar Tree is behind closed doors. Just yesterday, I asked it, what happens to my cost if I move 50% of this lane from spot to contract? Freight GPT will walk you through the trade-offs. You can benchmark your rates against modeled market levels so you know if that's a great deal. Pricing is built so that serious operators, from regional fleets to mid-market shippers, can afford to use it every single week, not just once a year during budget season. You have predictable access instead of surprise consulting invoices. If you're making decisions on hundreds of loads a week and you're still living in hectic spreadsheets, you're doing exactly what Dollar Tree decided to give up long ago. To see what this looks like on your own lanes, head over to freightfa.com. That's freightfa.com and start a session with Freight GPT. Turn your hunches into numbers you can actually negotiate with. So as we return back to the Dollar Tree story, one of the most underreported parts of this story is what's happening inside those four walls of those distribution centers. According to reporting from Supply Chain Drive and filings, Dollar Tree is replacing legacy warehouse and yard systems with modern AI-enabled cloud-based platforms. That's not buzzword bingo. It's showing up in their metrics. Let's look at Q4 fiscal 2025. Net sales grew about 9% year over year to roughly $5.45 billion. Inventory levels were down about 7% versus the prior year. Gross margin expanded by roughly 150 basis points to just over 39%, with gross profit up about 13% year over year. Earnings per share from continuing operations grew more than 20%, beating expectations and giving management the confidence to lay out stronger forward guidance. Now, that combination of sales up, inventory down, margins up, that's the holy trinity of a supply chain transformation actually working. You don't just get that by adding a distribution center. You get it by turning inbound flows so you're not drowning in the wrong types of inventory, optimizing routing and store replenishment, and more importantly, using real data to decide what to pay for capacity and where. In other words, this is not just a real estate story or even a weather recovery story. It's truly a systems story. Now, I don't want to leave out the most important part. This is a leadership story for Dollar Tree. In April of 2025, Dollar Tree brought Roxanne Wang in as its chief supply chain officer. She was a veteran of more than 30 years at Walgreens with deep experience in high volume retail logistics. So within a year of being at the company, she has a clear distribution center build out plan in Arizona and Oklahoma. And she's publicly talking about diversifying import sourcing, spreading volumes across countries, carriers, and ports to reduce tariff and disruption risk. The last point really matters because with tariffs and the geopolitical risk, we have to consider them now a permanent feature of the landscape. Diversifying imports is not optional. It's how you prevent your entire network from getting held hostage by one country, one port, or one carrier alliance. So what are the signals here for the rest of the market? If you're a carrier, watch Phoenix Metro outbound very closely. Litchfield Park Distribution Center is now an anchor for West and Southwest retail volume. I would expect more shippers to follow Dollar Tree's lead on these multi-year contracts with clear performance scorecards. The question is whether you'll be a carrier that qualifies or the backup plan that lives in the 2% spot pool. If you're a shipper, ask yourself this: can you sit in front of your board and explain freight exposure as clearly as Dollar Tree could? If not, that's truly your homework. Multi-year doesn't mean overpay forever. With tools like Freight GPT, you can structure contracts with indexed components. You can put in guardrails and reopeners so you're not guessing where the market is. You're negotiating from a data-driven baseline. So to bring it home, even though a tornado hit Oklahoma, Dollar Tree is still winning with a distribution center in Arizona, 75% of their freight locked into multi-year contracts, and a complete build of their Marietta, Oklahoma facility. And that's really the story. Dollar Tree went from being hammered by freight costs in 2021 and crippled supply chain in 2024 to using freight as a lever for predictability and profitability in 2026. It's truly a rebound story. And listen, you don't have to like every part of their model. You can debate how much contract coverage is too much, but you can't say they're guessing anymore. And if you're really impressed by Dollar Tree, start by asking, where is our network overexposed? Which lanes do we feel like need to be locked in? And which should we ride the market rates? And the perfect tool to help you with those questions is Freight GPT and FreightFA.com, where we can turn those questions into real numbers. So listen, thanks for listening. If this gave you something to think about, share this episode with your network. And if you're interested in more details about Dollar Tree, head over to Substack.com and search the Freight FA Brief. We've published the complete story of how they've done it in detail for you to read. If you'd like to support us, head to LinkedIn and Facebook and search the Freight Flow Advisor. Give us a follow. We post all of our articles and podcast content on those channels daily. And if you're out on the go or stuck in the daily commute, you can listen to this podcast on Spotify and Apple. Just jump over, search Freight Flow Advisor or the Freight FA Brief, and hit subscribe. Lastly, be sure to check out our YouTube channel where you can watch this episode. Until next time, this has been your Freight Flow Advisor Brief.